welcome everyone. Welcome to the next stage in our webinar series around COVID-19. So today we're looking at government stimulus packages. I'm Rob Douglas, the Executive Director of Australian Owner Manager. We're a boutique education and development company that focuses on the needs predominantly around the owners of mid-market private companies. And today we're joined by our partners at Deloitte Private, who are going to share with us what the government stimulus packages mean for business owners, and how you can maximise the benefits that you might receive from those packages. So I'm going to hand over now to Nick Ung from Deloitte Private, and he's going to introduce the team and take us from here.
Great. Thanks, Rob, and thanks for the opportunity to talk to you, the owners of private businesses around the country. We recognise this is a difficult time in the economy, and as a result, the government and state governments and the banks have provided some stimulus packs and relief packages to deal with these tough times ahead over the next coming months. So, fortunately, today I've also got Richard Wheeler and Tim Heenan. So Richard Wheeler is a fellow partner of mine in my private tax and advisory team here in Brisbane. And Richard's going to kindly look to share with you on a various amounts of incentives and relief concessions that the ATO and the federal government have provided with respect to the tax incentives. We'll also look to touch on some of the state measures around the country as well. I've also got Tim Heenan, who's a partner within our restructuring team based up here in Brisbane, again around supporting business owners and businesses and directors navigate their way through what is a challenging time, and leveraging some of the support that's been announced by the government around the flow of credit and how to navigate our way through with respect to that. I've also got Rachel Witt, one of my directors here. So I encourage you throughout the session to offer up your questions using the Q&A function of Zoom, and Rachel will be helping me collate some of those questions and sharing that with the rest of the room. So we will look to answer those throughout where applicable. But yeah, I'll hand that over now to you, Rich, to take us through.
Excellent. Thanks, Nick, and welcome to everyone. Where we're going to go with this and how we're going to run is to talk through the, I suppose, concessions that are available by way of enacted legislation or legislation that is to be enacted. Then we'll talk about the ATO's administrative relief and how that's working across the various size enterprises that are out there. And after that, we'll touch on the state government measures. So just in terms of kicking off, and I suppose what I would also say at this point in time is government have been quick to respond in many instances. However, what you tend to find when government announce initiatives is that often the execution and the delivery model comes later, and in some instances, I suppose we're yet to see how some of these things will evolve, and yet to have clarity in terms of how some of these things will evolve. Certainly, when we're talking about the $50 million and $500 million revenue caps and the like. So, where I'll start were probably some of the measures that were first announced early on in the piece that were around obviously encouraging continued business investment and continued spending. And so what people will have been aware of was previously there were immediate asset write-offs announced in prior budgets for small businesses that entitled businesses to write off assets that were purchased where that asset was $30,000 or less. As part of the stimulus package and encouraging expenditure, the government came out back on the 12th of March and said, where businesses acquired assets from that day forward, assets costing up to $150 million, the business turnover was less than the $50 million, that they were entitled to an immediate deduction, immediate write-off of that asset. Where that doesn't occur prior to 30 June 2020, that measure reverts to the previous instant asset write-off threshold of $1,000. One thing to note, and funnily enough, a question that I've been getting quite a bit over the previous fortnight is with respect to motor vehicles. There are plenty of people that have fleets and contemplating what they're doing with their fleets, whether that be downsizing their fleets or alternatively renewing and refreshing fleets where necessary acquisitions were to occur. The guidance at present is that the immediate write-off will be up to the luxury car tax threshold or the depreciation cost limit, which is the $57,000 number. So where someone might acquire a vehicle for $75,000 or thereabouts, the immediate deduction is capped at the $57,000. So then I suppose moving on to, well, what happens with respect to assets purchased after the 30th of June and are installed after that point in time? Businesses, again, the government's come out and said, well, you won't get an immediate write-off, but what we will do through to June 2021 is any asset that is bought that is a depreciable asset, important to note in the context of where you may be incurring building improvements and things that are deductible under building write-off provisions, capital works provisions in Division 43 that people may have heard about. This is saying that if it was an asset that you previously would have been entitled to the 100% write-off if you'd got in prior to 30 June, instead, if your business has an aggregated turnover of less than that $500 million number, you'll be able to deduct 50% of it immediately and then curtail the depreciation on the remaining half over normal depreciation rules. Now, just quickly, what that looks like for people is we've got a quick example here that Rachel's been kind enough to pop in, giving you an example under what would normally be the case, where a $250,000 asset, would be deducted over that 5-year period. Its useful life being 5 years, and what that looked like, and then what it looks like under the accelerated model that is to apply from 1 July 2020. So what you'll see there is there's no additional deduction or additional benefit, but rather a pulling forward of the depreciation deduction and a pulling forward of the tax benefit associated with ownership of those assets. Rach, any questions at this point on where we're going?
No questions have come through yet.
Excellent. Look, I'm not sure how many people are involved in the research and development space. One of the measures, obviously, that's contemplated is in respect of what does it look like for those assets that you have received the immediate deduction for. At present, it looks to be that in addition to obviously having that expenditure included as a deduction, that will be included in eligible R&D expenditure. So again, if you're entitled to the immediate write-off of the asset, in all likelihood, as is currently announced, that would be considered eligible R&D expenditure if it would have otherwise been the case. Right, so I suppose on to a couple more pertinent measures and measures that I suppose I'm having more conversations about. I think we've probably in the past fortnight moved beyond businesses looking to spend money. Instead, we're now looking at businesses looking at how to preserve cash and the incentives that are available in that respect. So what has been announced by government for smaller business, being businesses turning over less than $50 million, were these tax-free payments of anywhere between $20,000 and $100,000. So any business, so businesses that employ, irrespective of the amount of PAYG they withhold from wages, will receive a $20,000 credit into their integrated client account on lodgement of their March activity statement, whether that be a monthly activity statement or, in the case of larger withholders, obviously, or a quarterly activity statement. Now, the mechanism and how it's going to apply is that government will initially in phase one pay $10,000 to the minimum, being the minimum amount for eligible businesses, irrespective of how much that business withholds, as long as they are registered for PAYG withholding back on the 12th of March. What the calculation methodology that will apply is to multiply your PAYG withholding in that month by 300% in the case of a monthly remitter. And where that amount is $50,000 or more, you will receive a credit of $50,000 on lodgement of that activity statement. Where the 300%, so where your monthly withholding is less than $16,600, you will receive a payment equal to 3 times that. So in the event that someone withholds $15,000 a month in PAYG withholding from their wage payments, they'll receive $45,000 on lodgement of their March activity statement, and the additional $5,000 being the top up to the $50,000 cap in phase one, they'll receive that on lodgement of their April activity statement. Then where that goes to, if obviously quarterly lodgers, the quarterly lodgers will receive, if they withhold $50,000 in PAYG withholding for that quarter, they'll receive that amount. If they withhold less than the $50,000, they'll receive the amount of withholding in that March activity statement, and in the lodgement of the June activity statement, or on lodgement of June activity statement, they'll receive the top up to get them to the $50,000 maximum. From there, you go to the stage 2 incentive, which is for ease and simplicity in using the government's terms, the payment of which will be modelled on the initial receipts. So if, for instance, I was a monthly PAYG withholding remitter and I received the total entitlement of $50,000 over 1 or 2 of my activity statements, come the second phase, I will receive effectively $12,500 credit into my integrated client account on the ATO over the months from June through to September. So that's how the program is going to look. And businesses, I suppose, that may consider where they're positioned and what they might be doing, may look to make sure that we are where we are inclined to paying bonuses in June, where those bonuses are still going to be paid, and the annual payroll would otherwise, or the withholding in the period would otherwise be less than the cap. It may make sure that you are timing payments of bonuses and associated withholding, such as to get caught here to maximise the amount that you would receive by way of benefit paid into your integrated client account.
I think, Rich, it's also important to note that is applicable to each employing entity that
Yes.
can be within an aggregated group. So for some of those businesses that have structures where you have multiple employing entities, as long as your aggregated turnover is under the threshold, each employing entity will be eligible for this cash flow boost. So in some instances, multiple lots of this incentive.
Yeah, spot on, Nick. So where I have a group where I have 3, perhaps a parent company and 2 or 3 subsidiaries that are employing, each employing entity will be entitled to this cash injection on the basis that the group turns over less than $50 million. So there's been lots of questions about how's the $50 million going to be applied. I've got plenty of clients that are either just over or just under that threshold. Guidance that's come from the ATO and Treasury is that they'll apply the same methodology that people might be aware of that applied to determining whether a group or an entity was a small business entity, for the purposes of a $10 million test that exists in the Act that said, if you're in business, so first question, you've got to be in business. Second question, if you're in business in the prior year and your turnover is less than $50 million, aggregated turnover is less than $50 million, you will satisfy the test. Or your turnover in the current year is less than or likely to be less than $50 million, you would also satisfy the test. In terms of aggregation, aggregation looks at common control. So where you have a group, 3 companies controlled by a single parent company, all 4 companies would be grouped for the purposes of those thresholds. There's all sorts of questions about affiliates and control and the like that are yet to be explored. And I suppose that's the challenge with these measures as they're announced. In the absence of legislation, Treasury and the Tax Office are pointing towards existing legislation, which is a great thing to do, albeit that when you start to look and those challenges associated with applying the same methodologies or the frameworks that were traditionally used for other purposes to a new purpose, whether or not they are still appropriate.
So before we move on, I think we might just take a few questions, Rich.
Yep, go for it.
So we've got a few coming through that are quite similar. So I think Daniel asked about the multiple entities with common directorships. I think we just answered that in respect to they are separate. Yeah. So
yes.
That one.
So in terms of the test that's announced, in and of themselves, common directorships won't create an environment whereby companies would be aggregated for turnover thresholds. It's really around the concepts of control and ownership.
Yeah, and to cover off on a couple of questions from Ganesh and Ryan, and maybe also Peter, we'll cover them up together. Just a quick way to confirm. So if someone, for example, has a pay quarterly BAS with 50k deduction, if they withhold 50k a month, they'll get the 50k in the March BAS. Is that right?
Yeah, so they'll on lodgement of the March BAS, the $50,000 will be credited to their integrated client account, which is effectively the running account everyone has with the tax office.
Great. So I think that answers, Martin, your question in respect to how it gets paid. But he also had the question, does it need to be repaid? Is this a permanent or a temporary?
No, so this is a true cash flow injection. It is a tax-free payment from government. So if in accounting talk, it would be considered non-taxable revenue, so non-assessable revenue. So people will probably create a new account in their P&Ls or use a sundry income account, and come the lodgement of their tax return for the year ended 30 June 2020, that amount won't be included in assessable income. So it's effectively one of the few times that you'll see tax-free cash.
Great. And just from Therese, what is the process where in one entity you have a weekly remitter? Nick, I think you had a touch on this one today.
Yeah, so
Coming across this one today.
I can talk to, so generally where people are weekly remitters, consequently they are obviously large remitters. I have a couple of clients who are large remitters. The ATO are treating large PAYG withholders different from small business, obviously, because typically they are larger enterprises. There's a process, and there's an ATO. The ATO have a COVID hotline number. The ATO aren't automatically deferring these. However, businesses where they can draw a link to and show obviously the impact of the coronavirus, the ATO are, I suppose, broadly, and this goes beyond large remitters, the ATO are more than happy to help with deferrals of payments and negotiating deferral timeframes. With respect to these circumstances, the expectation is that the ATO provide, believe it or not,
okay,
complete
great.
lodge, and additionally they are creation obligations that have the deferral applied, but you would still continue to make your lodgements as required.
Great. Just one last question. We pay wages tax monthly, lodge the BAS quarterly. So cash flow is based on monthly or quarterly. So that'll depend if you're
that's
IAS
right.
or BAS.
So if you're a monthly withholder, it's obviously going to be that the calculation will be based on your March monthly withholding, and if it'll be 300% of the PAYG that you've withheld for the month of March. That will be applied to your integrated client account on lodgement of the March activity statement, and then subsequently you'll then go and lodge a April activity statement, and on lodgement of the April activity statement, you'll receive the top up to the $50,000.
Great. Just one final one, and then we'll move on. Is the 20 full-time employees a FTE calculation or actual numbers of full-time employees?
That's a very good question. That's one that I believe is considered to be headcount, not FTE. But I'll confirm that one and come back. I'm afraid I must apologise. I don't have any clients or many clients that employ fewer than 20 people, but I'll confirm that one.
Sorry, Richard, just one other question I saw come through. Does this apply to trusts as well as other business structures?
So in the respect to the withholding measures, yes, they do. It's an employing entity.
Great.
All right. So obviously the slide I've got up at the minute talks about, and that question alluded to, the wage subsidies for small employers that have apprentices and trainees. The mechanism for the delivery of this, Nick, I think you were talking to me about, is going to be rolled out early next month.
Yeah, correct. So from early April 2020, with respect to those registered apprenticeships and trainees, they will receive for the period of 1 January through to 30 September, 50% of their apprenticeship and trainee wage will be subsidised. So maximum amount over that 9-month period of $21,000 per eligible apprentice or a trainee, up to amount of $7,000 per quarter. So that's one that's actually been backdated a little bit to encourage businesses to continue holding on to their apprentices and trainees. No, you will need to ensure that this is registered and assessed through the Australian Apprenticeship Network. So there is a website there that we've attached that you'll need to ensure that they have undertaken an assessment with you for approval of that.
Yep, perfect. So just in terms of, I suppose, moving on that, the question with respect to weekly remitters of PAYG withholding, obviously large remitters. The challenge, I suppose, and touching on those cash incentives we were talking about, is those only apply to businesses that turn over up to $50 million in aggregated turnover. So I would generally suggest that if you're a weekly PAYG remitter, which means you're a large remitter, so you might find that you'll be challenged in terms of meeting the turnover threshold to get there. Sorry, Nick. Now, I think we've just jumped.
I've just got a couple of questions in respect to the apprentices. Will the wage subsidy be backdated? And what about new trainees employed post March 1?
Yeah, so the back payment will be reflected on what you have paid those registered apprentices and trainees from 1 January. So announcement got made on 12th of March. So they're actually allowing for a cash injection for a retro payment to 1 January. Those new apprentices and new trainees that you hire, you will just need to ensure that they are registered through that apprenticeship network and get that self-assessment piece first to be eligible for that subsidy.
Yep, perfect. So Now, in moving on and talking about, I suppose, the ATO's administrative relief measures that they've introduced and announced, there's the ability for businesses to defer payments on activity statements, being the BAS, obviously GST, income tax assessments, FBT, and so on for up to 6 months. You still have to meet your lodgement obligations generally, unless you've entered into and had conversations with the Australian Taxation Office about also deferring lodgement. Now, that's probably something that people may have coming up to 31 March, which is a lodgement deadline for larger taxpayers. People may wish to or may need to, A, for the purposes of actually completing the information, but then B, for the purposes of payment, seek not only a payment deferral but a lodgement deferral. One thing to note is it's important that you maintain the superannuation contribution obligations at this point in time. The other measures that were announced obviously were with respect to smaller enterprises, that you have the ability to vary your PAYG instalment down to nil for the March quarter on lodgement of that activity statement. So when people are lodging their business activity statements for the month, for the March quarter. And at the same time, in varying that down to nil, you're entitled to vary the annual expected tax down to nil and receive a refund of the September 2019 and December PAYG instalments made. So that's the tax that you will have paid towards your June 2020 obligations to the Commissioner on those activity statements. You're able to pull those back. Beyond that, and I suppose some of the things to contemplate with respect to PAYG instalments, and I've been working with a number of clients in this regard, turning over anywhere between 200 million up to large billion-dollar numbers, is that, as I said, the ATO are generally and broadly accommodating with respect to requests for deferrals of payments. They are asking that you call at the point in time or just prior to lodgement of the relevant activity statement at the point in time the obligation is about to arise. So when I say that, obviously, earlier this week we had an activity statement deadline being the lodgement of February instalment activity statements for monthly PAYG instalment payers and monthly business activity statement lodgers, GST remitters. The ATO were great on Monday with respect to, we've had instances where a GST bill of half $500,000 for the month of February was deferred for 6 months, and similarly PAYG instalments varied down to nil. The conversation is that rather than phoning now and asking that March's GST, April's GST, June's GST be deferred, the clear guidance from the ATO is don't phone, don't request the deferral until such points as the obligation is arising. So certainly ATO great with respect to getting things sorted for obligations that are arising now, but they won't work with you into the future at this point in time. They've also come out and made it clear that where enterprises vary their instalments down to nil, that come the payment time on lodgement of the 2020 income tax returns, that they won't be seeking to apply any penalties and interest where the PAYG withheld is substantially less than the tax obligation, and confirm that in the event that the systems, because the ATO systems sometimes are wonderful at this, in applying those sort of things automatically, that where the taxpayer refers to COVID-19, they will remit all penalties and interest on any underpayment of PAYG instalments. I've had a few questions from clients with respect to those who operate businesses through trust structures, and consequently, obviously, subsequent to distribution of income, the taxes paid by individuals or corporate beneficiaries or otherwise, and wanting to know what happens about varying PAYG instalments down in that scenario. Certainly, there's no mechanism to whereby the ATO are automatically saying you can receive a refund of prior quarter's instalments. Taxpayers have the right to vary their PAYG instalment down at any point in time up to the due date of that activity statement. Certainly suggesting to clients that varying their March instalment activity statement down, which won't be due obviously until April, that varying that down to a nil number is perhaps appropriate, and that it is again highly unlikely that the Commissioner will turn around to an individual who is the beneficiary of a trust or otherwise and suggest that they be penalised with a shortfall penalty in the event that it subsequently turns out that the PAYG instalments are substantially less than the annual tax obligation. So there's no clarity around that. The tax office and I suppose that's probably in line with the timing. We haven't yet had the March quarter instalment activity statements come anywhere near being due. They're still a month away. We'll probably see some movement on that sometime in the next month. But for now, those that are thinking forward, we're suggesting that it's probably appropriate to vary those down to nil to maintain cash in enterprises. And that certainly you'll have the opportunity, should the clarity come out from the Commissioner that no, they're not going to be willing to have that happen, you'll have the ability come July with the June quarter instalment activity statements to look to vary those. So another mechanism that the Commissioners come out with, the ATO have come out with, is with respect to those who are traditionally in GST refundable positions. You can opt to enter the monthly cycle such that you're obviously going to receive the GST refunds sooner. And then the final piece on this slide that I'll quickly touch on is the ATO are remitting interest and penalties, anything incurred after the 23rd of January 2020. Again, another measure to help businesses, and they've also talked to obviously businesses where you do have tax obligations, low interest payment plans to set where you continue to settle your ongoing liabilities, whether that be by way through a deferral or otherwise. So broadly, I'd just say in general that the ATO have been in all of our interactions at this point really willing to work with business, whether they be small companies right through to large PAYG withholders and large remitters.
Great, Richard. Just a few questions coming through from this slide. Is the GST deferment interest free, from Susan?
That's a good question. I understand that yes, they are, but and the reason I'm hesitant is that the ATO are agreeing a lot of these things over the phone, and it's not and indicating that deferrals will be interest free. But it's not until and all of these things are to be confirmed in writing. And I suppose it's not until we're starting to see the written correspondence coming through from the ATO to confirm that deferrals will be interest free. Great.
And from Marco, is there a way to get a refund on the pay-as-you-go instalment online rather than by direct contact?
So it will go to the size of the enterprise. If you lodge your instalment activity statements online or via paper, there's the boxes on the activity statement whereby you can vary the tax amounts. If you vary those amounts down, you'll see, and I haven't got one in front of me, unfortunately, you vary your annual expected tax bill, you vary that number down, then you see that there's a box where you have a credit, and if the credit is greater than the debit, so to speak, then that amount is refundable. So you can actually have a refund of PAYG instalments where you lodge those on a quarterly basis. You can receive that refund straight into your integrated client account.
Great.
Which is a mechanism that's existed all along.
Yeah. Question from Ryan. It might touch on what we're going to talk about later with Tim. Where you have bank finances, the banks don't normally like unpaid taxes. How do you anticipate the banks are going to respond? And do the government include and consider this when setting up these arrangements?
I can provide some anecdotal thought, but I reckon Tim would be better positioned to respond to that. I think whether we touch on that later, Tim, we might, because I think I was just about to hand over to you. We might let you talk to how the banks are likely to view ATO debt at this point in time in a minute.
Great. We've got a few questions coming from previous slides, so I think we'll touch on those once we get to the end.
Yeah, sounds good. Sounds good. Okay, so this, and we'll make sure Nick will make sure that these are available after with respect to some of the timings. I think the important thing to note in our interactions with the ATO and Treasury, the ATO are really keen to ensure that people meet their lodgement obligations, irrespective of their capacity to meet their payment obligations. And the reason, I suppose, for that is the ATO and Treasury are using the data that is generated through the business activity statement process, through the instalment activity statement processes and wage withholding numbers. They're using that data as a short lag time indicator as to where the economy is and what's transpiring in business. So I think I would advocate that everyone do all they can to make sure that they meet their lodgement obligations, because that the data flowing through from business in terms of what's happening in revenue-wise, turnover-wise, purchases, sales, wage payments and the like, providing great insight that will lead to further policy response.
Righto, and so part of what some of the government has announced as well is around the need and the support for the flow of credit into businesses and the like. And as a result, they've made an announcement around the coronavirus small to medium enterprise guarantee scheme. So what that is that's working with financiers and the banks to where the government will actually provide a 50% guarantee on new loans made to SMEs, so small to medium enterprises with turnover of less than $50 million. And that's going to be used for working capital purposes. What the government are looking to ensure happens is that there's a maximum amount of up to $250,000 per borrower. The terms of that loan will be up to three years with an initial 6-month repayment holiday, and that this loan be provided in the form of unsecured finance. So the owners and the directors won't have to put up any assets with respect to that loan. The government's going to be working with the actual lenders to actually ensure that those facilities and the quickness of being able to assess credit and access the credit is done pretty quickly. And there's a bit of an exemption around, obviously, responsible lending to ensure that that credit flows through to operating businesses such as yourselves. So we're seeing that come out through lots of the banks, in particular the big four, around what their relief packages look like with respect to this scheme in itself. So again, working with your financier and banks to start to have that conversation now around what that looks like or what that could look like for yourselves. But I'll hand over to Tim Heenan, who will also talk through around what happens around the relief for financially distressed businesses and what those safety net measures are currently in place.
Thanks, Nick. Look, it's fair to say in my observations so far is what government is trying to do, and the federal government in this, in what I'll be speaking to in particular, is to protect businesses. Yes, the impact of the coronavirus and the lockdown mechanisms that government put in place is having a significant impact on the viability of these businesses. But once this passes, the time frame's a bit unknown at the moment, but 4 months, 6 months, whatever that time frame is, the need for those services will be there, and those businesses that were viable in the past will hopefully be viable in the future again. Hopefully, so I'm a partner in restructuring. Traditionally, that's where the insolvency work sits. Hopefully, people on this call haven't had too much need to call on my services. And what government is trying to do is prevent that need, it's certainly due to the coronavirus issues. To provide a bit of background, directors of companies... Sorry?
Maybe just put on mute. Someone.
Can you hear me, Nick?
Yep.
Yep. Sorry, I just said there's a bit of background noise there. Fair to say, to provide a bit of background, directors of companies in the corporate situation have have duties under the Corporations Act, act in good faith, act in the best interests of the company, and also not to trade the company whilst insolvent. And what that has meant in the past is if a director is incurring debts when the company is insolvent, then that director can be found personally liable for those debts incurred. A couple of years ago, the federal government implemented safe harbour mechanism, which was a mechanism by which directors could rely on to get relief from insolvent trading, where they could demonstrate a better outcome could be reached than putting the company into voluntary administration straight away. And I've been involved in a number of those engagements, and they have worked well, particularly in an environment where the capital markets are available through a refinancing or sale of the business. And that is not the case at the moment. I'm reading a lot of reports where private equity, for example, is really trying to pull out and look after their existing portfolio. So what government has done, and effective from the 25th of March, is effectively said that directors will be provided relief from insolvent trading. That is, whilst they may suspect the company is insolvent at a point in time, and a lot will be triggered directly from the impact of coronavirus and what government has had to implement to prevent the spread, they will be relieved from any liability for insolvent trading. And what that does is prevent the need for directors to put the company into voluntary administration, and will hopefully assist in the optionality for that business to re-emerge following the crisis. And I think that's actually a really positive view from government. A couple of caveats there. One, the debts don't go away. It's going to be very important for you as directors of a company to think about and consider what position the company might be under a range of scenarios, and mainly around time frame, I guess. What that means for the financial position of the company once we start trading again on a BAU basis, because those debts will remain and they will need to be paid. So that's going to be a very, very important from a forecasting perspective. And secondly, there is a carve out, and I'm just looking away because I'm just reading out directly. And the caveat is, although egregious cases of fraudulent or dishonest insolvent trading may still attract criminal actions. So what they're saying is, it's talking about debts incurred in the ordinary course of business. So wages for current staff, ordinary supplies, utilities, rent, etc. We're not talking about all of a sudden going out and engaging in unreasonable capital expenditure, for example, when in the current environment you may not be able to pay that in the future. So they will still attract criminal penalties. There are a number of other measures on this slide. There's temporary increases to the threshold at which creditors can issue a statutory demand. Previously it was $2,000, now it's $20,000. And from a bankruptcy in the personal situation, that is from $5,000 up to $20,000 as well. And also importantly, the time frame to respond to that statutory demand. Previously, if you were issued a statutory demand as a company, you had 21 days with which to respond. That's been extended to 6 months, similar to the relief for directors from insolvent trading. So I think these are all very important. They stop the burning platform for directors to perhaps unreasonably go and appoint administrators, because once they're appointed, they're very hard to unappoint, and increases the chances of directors acting reasonably from emerging from this current crisis with a viable business. As I said, I think it is really important though to consider what position the business will be in and what debts have been accrued that have not been able to be paid due to cash flow issues during the period of this lockdown, and really understand what that position looks like, because you don't want to emerge from this and then realize that you actually don't have a viable business because of, albeit at very low levels, you've continued to accrue debts. I'll stop there. I think I've covered everything on this slide for the time being. Is there any questions to address now?
Did you want to start with the question we had from Ryan before around banks and how you think they might?
Look, I've had a number of discussions with banks over the past few days, and generally speaking, the banks are going to be very supportive of companies that have been impacted by coronavirus, and that has been made publicly, and that is in the conversations that I've had. And banks are already coming out and saying that they will give 3 to 6 months. I've seen 3 to 6 months loan repayment holidays. A couple of things to add in there. One, in terms of the tax point, I think, and my view would be, and a couple of banks I've spoken to have confirmed this, it will really be the difference between if you've had overdue, if you've had tax in arrears for 6 months leading into this, and they're just getting worse as the case of the coronavirus, and that's a different story. If these arrears are new and are directly attributable to the coronavirus impact or the COVID-19 impact, then I think the banks will be very understanding. But really, the main thing is to do, and this is the case before and after, is communicate. Be open with the conversations with your financiers. Be able to demonstrate the impact that COVID-19 has had, and they will be supportive. And they have been ever since the Banking Royal Commission and before. We've seen the banks become very much more client focused and customer focused than they have in the past. Another point to add there is in terms of new money versus deferral of repayments. Loan repayment holidays, which is the first bullet point in this slide, will be much easier than new money, and as in if you're going to ask for more money as opposed to just a loan repayment holiday. Banks are still required to comply with the APRA lending guidelines, and I think there are some announcements coming out with that as well. But if you are chasing new money, you will still have to demonstrate that business case for that new money to be provided. It can be challenging. I haven't got any examples to go off at the moment, aside from the discussions that I've had.
Okay, great. And if there's any, if people are looking to maybe use that government-backed guaranteed loan, is that, Ivan's just asked, could this be used alongside with the instant asset write-off?
Oh,
Richard, that might be one for you there.
Well, it says it's also for working capital purposes, right? So, you know, I guess in some instances that'll come back down to the bank's own self-assessment as to what it will be used for. If they consider that piece of equipment be sufficient enough with respect to how you operate and you need it as part of your working capital cycles for your business, then that'll be a bank's prerogative on that one.
Okay, great. And I've just had a few questions from before the session, so I'll just throw one in that relates to this bit. So you've touched on the regulations in respect to insolvency laws. Have they brought in new laws, or is it just something to guidance? And also, what's the impact on personal guarantees and personal liability if trading insolvent during this period?
It's an interesting point. It actually brings me on to another one. These laws have been passed, but they are really holidays. So in 6 months' time, they'll just revert to the current position unless there are other arrangements made. So these aren't a permanent change. If that answers the question. In terms of personal guarantees, I don't think it doesn't actually change the personal guarantees, these insolvent trading laws. Personal guarantees are between an individual entity, whereas a corporation, these insolvent trading laws are in relation to corporations, companies. So I'm not aware that personal guarantees will be impacted. Although I will investigate that and come back to the group on that if you like. Rich, Nick, I don't know if you've seen anything on that. Sorry, there was one point I was going to say. There are other cash flow, there are other mechanisms that are out there and will continue to roll out. I understand in New South Wales, there has been some legislation passed preventing landlords from essentially terminating the lease for commercial clients. I think there's a fair chance that might come through in Queensland as well, and I think that's beneficial. And I have seen some literature from some solicitors questioning whether leases that, you know, for tenants that are unable to enter their premises or utilise the lease, maybe there's an argument that those leases have been frustrated and tenants may be able to actually walk away from them. That's a question for the lawyers. It's just something I saw on LinkedIn yesterday, which was quite interesting.
That's the force majeure provisions, right? Where, you know, those sort of acts where you can't actually engage in those services. So again, referring that to your lawyers and your legal team to review those leases as to whether there is a force majeure contract clause in there that enables you to be able to walk away from the lease if needed as well.
Yeah, but
the whole
personal guarantees, I think, to that point, I've not seen anything that that people can walk away from those at the point. The thing to remember though is that these debts that we're talking about under insolvent trading, they don't go away. They still need to be paid. You're just not liable for them as a director if you are found to be trading whilst insolvent. If the director has signed a personal guarantee, then the counterparty of those may be able to call on them under the normal circumstances.
Another question from before, leading on from the rent relief, just a question around small to medium business in the metal manufacturing area. What's the process of seeking rent relief from existing landlords? And is it different in New South Wales and Victoria? They've thrown in New Zealand as well, but if you can't answer that.
My view is, and we've undertaken a few engagements where we've been negotiating with landlords prior to this to obtain rent relief, and that has been on the basis of, there's obviously been some challenging times in the retail sector in the past, of course, and a lower rent than what was currently being paid is better than not having a tenant at all. I think the process really will be speak to your solicitor and engage with the landlord. I mean, that's really the only thing that can be done as far as I'm aware. We'd have to wait for this legislation to roll out in Queensland if it does. But I think a reasonable conversation with the landlord, if I'm a landlord sitting there in this environment and I've got my tenant asking for relief on the basis that they will still be there when this comes out, I would rather have a tenant in there than not. Or that would be my prerogative. So I would have thought a landlord acting reasonably will be amenable. The challenge will be, of course, is if that is a corporate tenant and it's backed by a personal guarantee, which many are. Some landlords, a landlord may not be as reasonable, but you would hope in these circumstances they are.
And the biggest tip that I've got working with Tim and his counterparts in our restructuring team is to be really well planned, have your forecast models ready in terms of demonstrating impact, but don't be afraid to have this conversation with your landlords and the banks up front. I think we're not necessarily seeing too many negative stories where there is a knockback with respect to this as a result of your business being impacted by COVID. So it's about being able to demonstrate that your business has suffered from this shock, but your ability to be able to trade through it once things get lifted will give them, both the bank and the landlords, more comfort. So go into this up front, go into it well planned, but take and act quickly now while you can, rather than trying to wait for a period of time.
Yeah, this is being open and transparent is a key to getting a good result here. And now is the time for directors of businesses to be going through their P&L line by line and their cash flow line by line and working out where the savings are being made. A discussion with the landlord won't go so well if you go there and say, you're the only one that we're asking. You're the only one that we're asking for relief from. You need to be prepared to be able to say, we've gone through the business line by line. You're not the only one that is going to be funding our business or taking a hit. We are personally, we are downsizing staff if necessary. Hopefully not. We have gone through we're getting relief from our financiers. We've spoken to the tax office. This is the minimum amount that we need you to give us in order to get through the end of this, and also understand the timeframes, because that's the big question mark. The discussion may need to go along the lines of, look, we've looked at what we need to do if this lasts for 3 months or 4 months. This is what we're asking for. This may change. Once we hit the 3-month milestone and based on the new outlook, we may need to come back and have another discussion. So make sure you're aware of the package of measures that you've taken, are ready to have an open discussion with that with your stakeholders, and also be aware of the timeframes that you're talking about.
Just conscious of time, Rich, we might want to sort of race through these state government measures.
Yes. Yeah, perfect. I'll steal back control. See how we go. While I'm doing that, I've just seen a question in terms of leasehold improvements and whether you're going to be able to access the immediate write-offs with respect to leasehold improvements. Challenge there is a technical one as to whether the item in question or the asset in question, whether it is considered depreciable plant or whether the asset is instead considered to be a capital works building improvement. So simplistically, if it's part of the building, so screwed on, affixed to, then it's generally considered to be capital works, and the 2.5%, 4%, depending on the rule, write-off applies, and you won't be entitled to an immediate write-off for those things. If instead it was perhaps a LCD screen affixed to a wall, well, that's still considered, because you can remove that and place it elsewhere. Again, really simplistically, that the TV is still the TV, whether it's on the wall or not. It's considered to be plant and equipment, and therefore you would be entitled to an immediate write-off. So things where it gets incredibly technical around air conditioning plant versus air conditioning ducting, those sort of things. So yeah. Okay. So state government incentives, and noting time, I'll probably just jump to Nick. Have I got control here?
Yeah, it should be.
Wait a minute.
Give it a go. Just press right.
Thank you. There we go. Right. So what I'll do is I'll talk to Queensland initially, and we've got further content there with respect to the other states, and I'm sure that we'll loop back round with respect to the content, and certainly can provide some further detailed responses in respect of some of those questions. So probably by far and away, Queensland has been the most generous at this point in time with respect to payroll tax obligations. So where the situation is at present is that for smaller payers where the taxable wages is $6.5 million or less, so that's Australian taxable wages, so basically your payrolls across the country, where that's $6.5 million or less, the Office of State Revenue are refunding you the prior 2 months payroll tax and giving you a 3-month payroll tax holiday, as well as the ability to defer payroll tax payments out for the remainder of the 2020 calendar year, so through to January next year. Where businesses have Australian taxable wages of greater than the $6.5 million, and this is one of the biggest differences at present to other states, is you are entitled to defer payments out to 2020. So the mechanism by which you apply for it is really simple and straightforward. You simply jump on the Office of State Revenue website, COVID-19, and having got to COVID-19, the link, it's simple. It's a simple click through, and in clicking through, you're able to highlight, name of the business, the registration details, and so forth, and are in a position to defer per the schedule on the right-hand side of the slide there. There's also talk in terms of low interest loans and repayments associated with those sort of things. I won't talk further on those, but we can circulate some detail. The power bill piece is, I think, been announced. Businesses will receive, I think it's a $500 rebate towards their power bills. Again, nothing substantial. And something that's been announced but yet to have further detail, I suppose, touches on the business rent piece. Not sure to what extent many attendees are occupants of government-owned buildings, but the government has come out and said that they're going to provide rent relief. But again, that's yet to be clarified and yet to have any detail provided with respect to that. So then I suppose the other state measures typically have much lower thresholds. So Victoria, it's $3 million. In terms of New South Wales, we're talking $10 million in their Australian taxable wages. So these measures we'll circulate and make sure that everyone is informed following this, where they have employees in other states. But things like Victoria are providing, again, relief for tenants of government-owned buildings. Tim's talked a bit more about what other states are doing. You've got, liquor licensing fees, which are being waived. Again, not huge, but in the scheme of things can go a long way to adding up. Tasmania, South Australia and WA. Nick, I probably in light of time might just allow for any other questions, and we might share content.
Yep.
If we, just a question. Oh, sorry, Nick.
I was just going to say, we'll share these slides around, but we'll close off with the final questions there, Rachel.
Yep, so just in respect to some, I guess, accounting entries, if we've received our payroll tax refund, lucky Amanda, you've received some, is this classified as non-assessable income, or how do we treat it?
That I believe will not be a non-assessable amount. It's just a reduction of the previous expense. So you were entitled to a deduction. Now you got that refunded back, so it should just neutralise itself out. It won't be tax-free in that instance for payroll tax.
Yeah, okay. That's correct, Nick.
And in respect to, I guess, on the same sort of theme with the pay-as-you-go withholding, the money coming back as a credit to your integrated client account, how do we treat that in our accounts?
Okay, so I think the things to distinguish between the only thing that you would consider to be income or revenue in nature is the government cash incentive. Nick, you've just got something up in front of your slides. I can't see. Can't see the slides there, mate. The only thing that is considered income and revenue, and that is there, and also non-assessable, non-exempt income, is the cash flow injection of up to $100,000. So people will receive between $20,000 and $100,000 where they meet those eligibility criteria. That amount you put straight to sundry income or otherwise, and it's non-assessable, non-taxable amount. With respect to PAYG instalments that you are having returned to you, these mechanisms are all deferral mechanisms. So if I receive a refund of PAYG instalments, previously I would have credit bank and debited provision for income tax when I made those payments. When it comes back, it'll come into my integrated client account, and I can request a refund from my integrated client account. It'll be simply that you'll be reducing the amount that you've got sitting as a debit in your provision for income tax, and consequently increasing your tax liability for the future at the point in time that that's paid. The same applies with respect to PAYG withholding, where people are having deferrals applied with respect to their PAYG withholding. I would be suggesting that for ease of accounting, that you maintain your payroll remains as it always has, but instead you'll have a PAYG liability on your balance sheet for PAYG withholding that will grow over time and then subsequently be met. I think it's important in terms of these deferrals, the conversations anecdotally with the tax office are not that people will defer for 6 months and then all of a sudden we'll have cash in the bank and clear debts in 6 months' time, clear 100% of debts in 6 months' time. The expectation is that subsequent to the expiration of the deferral, the agreed upon deferral timeframes, is that people will simply be in a position whereby they will have to and will enter into renegotiations with the ATO about payment timeframes and further deferrals.
Yep, we just had a couple of people comment about South Australia and how they're a little bit slow on the uptake.
Yeah, agree. So personally, as a client servicing partner, my largest client is headquartered in South Australia, it's so I'm quite intimate in terms of determining what's going on down there. And yes, South Australia is very slow to react.
So was Victoria as well. They only just come to the party last week, so.
Just a final question from Sarah in respect to the Queensland state measures. Do they at all conflict with the ATO cash flow package?
No. So where you have access to state government measures, they will not preclude you from accessing federal government measures and vice versa. Very good.
Great. That's all the live questions that have come through. And I think the questions
Wonderful.
that came through from the pre-questions, we've answered most of them in discussions.
Right.
Thanks, Nick, Richard, Tim, Rachel. Fantastic, excellent explanation of what's happening out there. And apologies to everyone that we didn't quite get the time to talk through some of the state government measures. But we'll circulate these slides. We've also recorded. I've got a few messages from people that had the time slightly wrong, so we'll make that available for those that have missed it. There's another webinar tomorrow at 12 noon Queensland time, which is focused around owner wellbeing and resilience. So if you can join us for that, wonderful. But once again, thanks to the team at Deloitte Private, and we look forward to keeping in touch with you as we move through this challenging time in the economy. Thanks very much.
Thank you, Rob.
Thank you. Bye.
Good luck everyone in managing through it.
Yeah, well done.